AI is only as powerful and as knowledgeable as what there is out in the market at the moment, out in the world at the moment. And it goes and picks those things. It's very good at doing it, but it only uses existing content that's in the world.
Paul Chalmers, owner and CEO of the UK Trading Academy, has been in the game long enough to know what works and what doesn't.
Retail traders lose money, institutional traders make money. Why teach people retail trading when retail traders lose? Why not teach people how the market moves? What I would suggest to people when they first start trading is that they would trade during the most liquid times. You're talking about 7 o'clock in the morning till about 4 in the afternoon. That is the optimum time when the markets are reacting to news, to various announcements that are coming out.
If you're ready to trade smarter, not harder, this episode's for you.
With the trades that we do, they are quality rather than quantity. Overtrading is one of the main reasons that people blow their accounts. You should never put greater than a 1% risk on any trade. And for all the trades that you are running at any time, you should never expose more than 3% of your account.
Welcome back to the Wayond podcast, where every single week we explore the pathways to success and beyond. Today we have a man that needs no introduction. We have Paul Chalmers, the founder and CEO of UK Trading Academy, huge trading academy, one of the biggest in Europe, I believe.
Yes.
And today we're going to be discussing with Paul to build the complete trading plan for you guys to benefit from. Paul, there's going to be 5 subjects I want to tap into today. The first chapter is going to be when to trade.
Okay.
Second subject is going to be what pairs to trade, risk management, technical analysis, and finally, trading management. So let's dive into the first subject, when to trade. I think many traders wonder when is the best time to trade. How important is it choosing a specific time to trade in your trading plan?
If we take it for the beginners, let's look at the people who are trying to make profits and maybe not succeeding, or they're starting as well, and they say, well, when is that best time to trade? What I would suggest to people when they first start trading is that they would trade during the most liquid times. And that is going to be the UK session. So you're talking about, from a UK standpoint, you're talking about 7 o'clock in the morning till about 4 in the afternoon. That is the optimum time when the markets are reacting to news, to various announcements that are coming out. But also that is the biggest liquidity time where most of the trading is done, because you have a number of sessions. Obviously the UK, you have the Asia session, which is very, very quiet. And I would suggest that nobody trades the Asia session, especially if you are a newcomer, because the market doesn't move so much. So you have to have some movement. I always say that it's no good surfing on a mill pond. Often the Asia session is like a mill pond. It is very flat. So you need to be able to have something which is going to move, because to be able to make money, the market needs to move. So I would suggest that the best time to trade would be normally during the UK session.
And I guess, what advice do you have for traders that can only trade during certain hours a day? Maybe it's after work. Can they still build a trading plan around their limited schedule?
Yes, they can. Now, that is totally compliant on strategies, and we'll talk a little bit about how we build strategies up later. But a strategy has the ability to be able to trade during different market periods. Asia is a little bit more difficult, but a proper trading strategy can work any time of the day. What you have to do, and it's very important, is the stages that we will go through when we are talking about how you build your strategy and then how you implement it. But you can be able to trade at any time. You can fit trading around your work. You don't necessarily have to be. And I wouldn't suggest that people are sitting in front of a screen for 8 hours. You know, you can adjust a strategy by adjusting the time frame that you put it on. So therefore, you can trade around your current lifestyle.
So a lot of traders struggle with overtrading. What personally did you do to stop overtrading? Because taking too many trades can eventually harm your current trading journey.
Yeah, it's a very interesting subject, this is, because we provide our students with trades. When we are going into a trade, we tell our students what trades we're going into. And they get shocked that sometimes it's only 2 or 3 a day. They want more. They say, well, can't you give us more? Well, yes, of course we can. But with the trades that we do, they are quality rather than quantity. When you chase the market, in other words, you've had a couple of losers and you're chasing the market, you will continue to trade because you say, I'm going to get a winner now, which is going to cancel out a lot of the losses that I've had. But over trading is one of the main reasons that people blow their accounts.
And are there any times you don't take a trade at all, like during a holiday or when the market's quiet?
First of all, if I get up in the morning and I've had a fight with the wife the previous night and I'm in a bad mood, then you don't trade. You know, I'm using that as a crazy example, but you have to be in the right mindset in the morning to trade. As an example, you would get up, you would have a cup of coffee, maybe a little bite to eat, so that you're ready for the day and you're in the right mindset. But also, as well as that, there are other facets to being able to trade and when to trade and how to trade. And what I would always go back to is that the strategy will tell you when to trade. You don't try and push, you don't try and force a trade that isn't there. And a lot of people do this. And what they end up doing then is going back to the first question, which is overtrading, because they're putting too many trades on. But also the strategy that they have, there is no trade that exists. They think there is one. There's a lot of this that does happen. So you're thinking, I'm going to place this trade, but there isn't actually a trade there. And as well as that, the other ones are on news. I teach my students a very, very safe way of trading. So we don't take any risks. As an example, on the first Friday of every month, there is non-farm payroll. It's the biggest news event going. We do not trade on that day. I tell my students, you might as well go to a casino and put it on red or black. And other news events that we have coming up, if they are in a trade, we teach them how to manage red news events. So for instance, if they're in a little bit of profit, we'll tell them to bring their stop loss to zero. In other words, when a news event is coming out, we know what that is because the part of the plan that you do in a day is the first thing that I do every single morning is I go to Forex Factory and I have a look to see what news is on. I have a look to see what currency pairs it on. So if there's a large news item coming out and I see a trade coming up, say it's on at 1:30 in the afternoon, that's normally US dollar. When the US dollar news comes out, 1:30 in the afternoon UK time. If I see a trade coming on at 11 or 12, I won't even take it because I don't have enough time for that trade to play out before the news comes on. Or I will look at currency pairs which don't have any news that day and concentrate on them. So that is a few sort of pieces of advice that I would give to people where news can be volatile. A lot of people try to trade the news, but a lot of people get burnt by doing that as well. So there are things that you can do to avoid news and avoid, tears because you're losing money.
And being on the subject of trading currency pairs, as a beginner, what are the most important pairs that a trader should focus on?
If you're starting or you haven't been doing it so long, I would suggest that you stick to the majors. So anything with a US dollar cross in it. So Euro US dollar, GBP US dollar, US dollar Swiss franc, the New Zealand and Australian dollar against the US dollar. I would stick to those majors. Why? Because they're not as volatile as the minors and the exotics, and therefore they conform more to technical analysis. And you have great liquidity, but you also have a lower cost of entry into a trade. So the spreads, for example, on the majors are far smaller. So what you're doing is you're going into an area which is safe. It's safer because what you want to do is you want to build your skills up as a trader first of all. And the way to do that is not in a rat race. It is something far more safer, far more calmer. And those markets that I've just said tend to be the ones that most people will start at or should start at.
So of course, starting with USD because of its strength is important. But when a trader comes to start trading pairs, should they trade all USD pairs or should they do one at a time?
What you should do is it all comes down to strategy, your strategy. One strategy may not work on different currency pairs. So if we're getting into now how you start to look at building a strategy, but let's look at the currency pairs as well. I would always suggest to people that when they first start a strategy, they use it on Euro US dollar. And if you If it works on euro US dollar, normally it will work on the other currency pairs. So certain strategies would be good for certain types of markets, asset classes, and others would be suitable for a different type of class. But the only way you can do that is that you would do the analysis going back for 2 years. That is the key thing that I tell everybody. If you have a strategy, take it back 2 years on a Euro USD first of all, and see how it plays out. Then swap to GBP Japanese yen. So I've gone from a very, very stable market to GBP Japanese yen, which moves significantly in a day. So you do it on one, and then you do it on GBP Japanese yen. That will give you an understanding whether that strategy is going to be a successful strategy or not.
And I think that's a good point you brought up, backtesting the trading strategy. What are your thoughts to people that backtest the trading strategy for a couple of months, then they go to another one, then they go to the next? How long should someone, I guess, focus on a strategy? And should they only focus on one?
Yes, they should.
Okay.
When you're looking to get a strategy to be able to trade, and this is the hedge hopping that you just talked about, a lot of people will try a strategy for a short period of time. And then, oh, that's not working so well. Or let's look for another strategy. Let's look for another strategy. But that isn't the way that it should work. What you should do is you should have a strategy and you should test it thoroughly. Now, testing thoroughly isn't over 3 months. You should go back 2 years and you should test that strategy over the 2 years. When you've tested that strategy, you will write down every single trade, the day and the time. And then the next thing that you would do is put it into an Excel spreadsheet. And then you can start working magic within that Excel spreadsheet, because what you're looking at doing, first of all, you say, well, if I just do something simple, I'll put a 1% risk on it. So in other words, each trade is 1%. You tot them all up and you see, is it profitable or not? If that strategy isn't profitable, then it's pointless going any further. You can vary things when you're more experienced, that you can play with a strategy to be able to do it. But when you're first starting off, or even if you've been trading for a couple of years and you're still not successful, you should then move to the next strategy only once you've done that, because people don't give things enough time.
And you talked about risking 1% per trade. What is the ideal amount a beginner should be risking per trade coming into the markets?
I teach all of my students exactly the same thing. You should never put greater than a 1% risk on any trade. And for all the trades that you are running at any time, you should never expose more than 3% of your account to the market. So those are the two figures, 1% and 3%. So in total, 3% out of all the trades that you're running. But for each individual trade, never greater than 1%. And what that means, let's talk about what 1% means. That means that you would have to have 1,000 trades losing to lose your account. Now, when I'm on stage, one of the first things I do is, please put your hands up who's blown their account. And most people do. Yesterday it happened when I was, in the finance summit on stage. We asked how many people have blown their accounts. And most of the people in that room said, yeah, I've blown my account. And then I said, well, that's almost impossible. Did you have 1,000 losing trades? And you could see people saying, what do you want about? 1%. I lose 100 trades. No, actually, because you're looking at the equity that you always have. So if you've lost a bit, you're putting 1% of what you actually have. You'd have to lose 1,000 trades in a row. If you've done your back testing correctly and you have 1,000 trades losing in a row, you're going to move on to something else because that is useless. So there is a formula that I use that we'll go into a little bit later on how I develop a strategy and what money management do I put towards that.
Yeah, no, that's a great way to look at it from that technical perspective. It really broadens your eyes on, if you do keep the discipline of setting 1%, that's a lot of trades that you can take, really. And so I guess setting your stop loss right at 1%, what's the mindset behind when it hits? How do you, I guess, control that fear of like, okay, I'm gonna lower it a little bit more and all that?
No, that's a great question, because this is something that so many traders do and then lose much more than they planned. Because we've got something called Edsel-Murphy, the Edsel-Murphy law. If it can go wrong, it's going to go wrong. So your market has moved against you. You say, I just move that stop loss a little bit. And that is the time when the market will continue down in the wrong direction. Instead of losing 1%, you've lost 4 or 5%. That means that your stop loss and the psychology around it is based on this formula that we will go through on how I develop a strategy and how I make sure that that strategy is not only going to win, but I am going to be in control of that strategy every single minute of the day. And what I mean by that is that I will learn my strategy, all its nuances, and I'll explain how I do that afterwards, so that I know what's coming up. I will know when is a losing run. If I've gone over 2 years and I've put all the trades as I would have taken them in a row, the first thing that I do is I actually don't look at the bottom number. As long as it's positive, I'm happy. I actually go to look at the number of trades losing in a row. What is going to be my biggest drawdown? Now, if that says I can do 7 in a row, and it's never more than 7 in the last 2 years, if I'm risking 1%, and this is where the psychology, and this is where I take out the emotion with this formula that I have, how I develop a strategy, is that I will know that sometime in the next year or so, I'm going to have a number of periods where I'm going to have 7 trades losing a row. Now, if I'm trading 1%, that means I have to be happy in my head with my risk tolerance that losing 7% of my account during a period of time where I know over the 2 years it's going to make great profit, that means I become as one with my strategy, because when that happens, it doesn't worry me. This is that period of time. I know it's going to happen. We're not going to have more than 7. It could be 3, 4, 5, 6, maybe 8 one day. So what? I'm happy to place 1% a trade on that losing period, and my account's down 7%, because I know in a 12 months it's going to be up 96. I'm not worried about the 7% because I know it's coming. And that is what I mean by as one with your trade. If you knew everything about your strategy, you know the various... I coined a phrase in 2012. It was my phrase that I put out into the industry. It's called the OMG cycle. If you've ever heard of that, I'm the person that coined that phrase. And what I mean by the OMG cycle is that within a 12-month, there are going to be mini cycles within that growth period. It's going to grow because I'm not going to trade a strategy that doesn't make money. So I know I'm going to make money. But you have periods of time there during that growth that you're going to go through certain sub-cycles. Say, for instance, we had just had a run of 15 trades which have won. And somebody started at the beginning of that 15 trades. They'd go, oh my God, this is incredible. I'm just making money after money after money. And then they tell their friend, and their friend says, okay, I'm in on this. Yeah? So they start trading. But after those 20 wins, there's 7 losses. After those 7 losses, that guy's going, oh my God, this is terrible. But it's not. It's just part of the cycle that you go through in a strategy over a certain period of time. And that's why you need to do it over a longer period of time. So from a psychology point of view, my students learn how to manage their emotions because of the way that we teach. We teach in a very different way to most people. That's why our students are successful, of course, is because they get taught not just a good strategy or not just good money management, but also the one thing which a lot of people lose money because of, and that's the emotional side. If you already know what all the emotions are going to be, then when it comes to it, it's not that bad. You don't like losing 7 trades in a row, but you know it's going to come. And you know you're going to have the purple patches where you're going to win 10, 20 trades in a row. But if you know your strategy, you know what it's going to be doing, then it's far, far easier from a psychological point of view and from an emotional point of view that it doesn't become a roller coaster that a lot of traders get into. And then they start saying, oh God, I've lost 3 or 4. I better up the amount of money. And that's how people blow their accounts, because they just keep putting more and more on to try and get back what they've lost. Like a martingale, not the same as a martingale, but some people were saying to me yesterday, I lost all my trades and I only placed 20. Well, what money management did you apply to that? Because it's impossible. Now I know why you've lost your your account. But that means that whatever you've learned is wrong. Whatever you've been taught is wrong, because if you'd applied the correct money management, you'd still be in the game. You might have lost 6 or 7% of your account, but you've got 93% left. So that's how I do it. It's a certain formula that I've got that teaches people how to analyze a strategy properly. Put the money management around it then from what you see as the worst possible situation. Now, some people may say, oh God, 7% is a bit too much tolerance. Okay, well, don't put 1% a trade in, put 0.5% a trade. You won't make as much, you'll make half the amount, but it's still a great amount to make. But then the worst possible time, it'll only be 3.5. Does your risk tolerance is happy with that? Well, if it is, great, do it. So you put your money management around the back testing that you do, and the back testing is so important. And I don't mean like back testing on MetaTrader 4, where a lot of people, or 5, where they back test and say, oh my God, it's made £1 million. And then when they go and do it live, because back testing, you actually need to go back in the market and look at your strategy manually. Don't run some EA or something with it, manual, and say, this is where I would have placed this trade. And you actually do it manually. It takes a while, but my God, will you benefit in the end.
So the confidence when a trader is on a consecutive losing streak is knowing your strategy.
Yes.
So if we're to flip the roles around, someone's on a big winning streak, what is the mindset behind staying disciplined when you're in profits?
A lot of people will try to keep going in the same direction, putting more money on. I've just made, the last 4 trades, I've just made a lot of money. Let's put more on the next trade because this is going great. But that'll be the trade that loses. So again, as I said, you're down to a trading plan. Right, let's go to the next stage. So we've said, all right, we've got this strategy. We're now going to back test it for 2 years. We're going to put all of those into an Excel spreadsheet. We're going to see the worst possible situation. And then we're going to base our money management around that. So the money management side is okay. The trading plan is what you're getting at here. The trading plan gives you the rules of your strategy. So what I'm trying to do is make you into a bit of a robot instead of an emotional person, because you know how much you need to put on at all times. You never vary from it. But the trading plan gives you the entry criteria, the times that you will do it, because when you go through this Excel spreadsheet, you've now got data. Data is everything to be able to analyze. You may go through that data and you find that every trade that I do from 4 o'clock onwards loses, or 80% do. Take it out. You automatically, what you're doing then is you're analyzing that data to make it even better than it is. And you will see certain criteria like that coming out, certain things that happen. And if you take those out and amend your trading plan as such, then what you're doing, you're just refining and improving that trading plan. But those are the rules and you stick to them. If it says when I'm in 50% profit, and what I mean by that is 50% towards your take profit level. So if you've got a trade and your strategy says you put a 30 pip take profit, a 20 pip stop loss, if you go 15 pips, you have found, because when you go through a trade and when you go through 2 years worth, you see things. Oh my God, if I only did this every time, I'd make much more. So you may go back through that trading plan and you say, okay, well, actually, when it gets to 15 points profit, take my stop loss to 0. Because if the market does reverse, it reverses quite significantly and it could hit my stop loss. So what you're doing is you're growing you're improving your strategy because of the data that you have. And a lot of people don't do that. They see something on the internet which says £97, buy it, stick it on your computer, put £1,000 in, it'll be $1 million by the end of the month. It doesn't happen. How could anybody ever put something, put trades on something that you've never checked, that you've never back tested? So these are the reasons why so many people lose money, is because they don't do certain fundamental analysis that needs to be done to be able to get a successful strategy.
Very, very well said. I'm very, very curious to know more about your trading strategy that you teach people, and I kind of want to go into the more technical side of it.
Yes.
When it comes to your trading strategy, what are, I guess, the main tools or indicators that you use on the charts?
I'm not a fan of indicators. Indicators normally tell you half an hour too late what you should have done. If you'd only got into this half an hour earlier, I'd have made some money. Indicators, I do not use at all, apart from a Fibonacci, but that is a forward-looking indicator. So indicators do not form part of the strategies that I teach students because they're not good enough. They always tell you when to get in too late. There's a conspiracy theory that the institutions made these indicators to get people in too late. So they're already in a buy, 3/4 of the movement, then the indicator says buy. Now they've got them all trapped. Then they'll take the market up just a bit more for more people to say, hey, this is going up and up and up, and then they'll turn the market the opposite direction and take most of the people's money. Now that is a conspiracy theory, but it actually happens. I can show you, I can put an indicator onto a MetaTrader, and I can show you it happening. And I can see it happening. Now, we know that doesn't happen, but as I said, indicators normally tell you half an hour too late what you should have done. So we teach institutional trading. In other words, retail traders lose money, institutional traders make money. Why teach people retail trading when retail traders lose? Why not teach people how the market moves? So we teach something called price action. We teach students how to feel the market. I know that sounds a little bit weird, but the market moves in certain ways. It's going to be moved in certain directions because if you think of it in this way, it's a very basic way and it's not 100% accurate, but you'll understand. Hopefully the viewers will understand what I'm saying. Retail traders are taught certain ways with indicators, with all goodness knows what type of strategies based on indicators. Institutional traders are all trained the same way. They will take the market to certain levels. They will look for pockets of liquidity which haven't been used. A lot of support and resistance, but they're really pockets of liquidity. Now what happens is those institutional traders are all trained in a certain way, and therefore when the market moves to what the institutions are doing because they are the ones that move the markets. Not somebody putting a pound a point, putting millions of pounds in on a trade. So if all those institutional traders are trained the same way, they're going to want to move the market to the same positions that they've all been taught. And therefore we teach, and that's price action for you, yeah, where a market's going to go to and where it will probably go next.
So price action is what you teach your students.
Yes, it is.
Why is price action the best out of all the other strategies?
Because the institutional traders get taught like that.
That's it.
That's the reason.
What is that?
When a market moves to a certain position, it is moved there for a reason. And there is an expectation when you learn price action of where it's going to go next. You're only looking for an edge in this industry. You're not looking for the 80-90% winning trades. You're never going to get it. We have a great percentage. It's around 68. Now that's a heck of an edge from 50. But even if you've got a little edge of 55, 57%, that will still make you great money as well. But what you have to do is that you need to assess the market, what the market is doing, what the institutions are doing, and it's better to follow the institutions than to be a retail trader. So they are getting to learn what the market does next. And that's why I want to talk a little bit about AI and how AI helps me and helps my trading team to be able to trade the market successfully.
Well, let's dive into that right now because I'm very curious. A lot of people talk about AI, they talk about automated trading. So how does AI play a role in your current strategy?
Unfortunately, a lot of people have jumped on the bandwagon of AI. And you see strategies, indicators, AI generated. You know, this is an AI strategy. That's actually a load of rubbish. And let me tell you why. AI only depends on what it has learned in the past. So when you go to ChatGPT and you say, which a lot of people do now, I just want to make money from people selling courses. So you go to ChatGPT and you say, please make me a Forex course Yeah, with a couple of strategies in it. And I want to, I want it to be 20,000 words long. Yeah, so I can package it up and sell it. Yeah, this, I'm an educator. I'm going to do it. They don't know a thing about it apart from what they're going to write in ChatGPT. But that generates. Now, what does ChatGPT use to generate that information? What does the AI use? It can only use what it knows. And this is where people get things wrong. They think this is something that can invent things all the time. Okay, AI cannot invent things. AI has to learn just like a human. When we're born, we take in information. We don't have anything at the beginning. We just take in information. And we generate a certain amount of knowledge within our brain. And then when we experience something different, then we add more information to make us more aware and able to do things. Artificial intelligence is the same. People think that, we can make some incredible strategy from AI. No, that's not the correct way to think about it. Let me explain a little bit more about how we use in UK Trading Academy AI to help us. We have our existing strategies, which we have coded into our AI software. But what happens is that but it only knows what's happened in the past, not what's coming up. So we can enter all of that data into it, and it says, okay, I've got an understanding now of what this strategy does over the last 2 years. But it can't suddenly make it better. People think AI, oh my God, I can use AI and I'm going to do something better. You can't. The reason you can't is that AI is only as powerful and as knowledgeable as what there is out in the market at the moment, out in the world at the moment. And it goes and picks those things. It's very good at doing it, very good at making stuff for you, but it only uses existing content that's in the world. And people think there's something magic that it can think of things that people haven't. No. So this is how we do it. We have a database. So when a certain market price action, market movement comes up, our software looks at that movement and then it will put it into the database. And it'll say, I'm going to monitor this for the next 1,000 times it happens. So it's doing something that we can't do. It can churn figures like mad. We can't do that. We can't see those things. This is where AI is beneficial. But it isn't something magic. So what it's going to do, every time it sees a different movement, a different price action in the market, it stores that in a database. And it says, right, I'm going to watch every time that it does this now. And it will monitor it and it will say, I've just seen that happen. When it happened, what happened to the market? And the software that I designed will look at 3 things. Is the market flat? Does the market go up or does the market go down? Now, what happens then is it starts generating and storing that information. And when it has done 1,000 seen it 1,000 times, it'll then tell us, actually, the market goes down 70% of the time. It goes flat 10% of the time, and it goes up 20% of the time. That means that it has said, if we find this in future, we're going to place a sell. That's why I get 68 to 70% accuracy, because we're only going into trades that our AI system has found for us as time is going by, that allows us to have 68 to 70% expectancy that that trade will go in a certain direction. Now you're using AI in the best form that it can be going forward. And the great thing about this, the way that we've using our AI, is that markets change over time. Yeah, a strategy that worked 10 years ago might not work correctly now. But with this, the software, the system, is accumulating this information. And all of a sudden, it starts to see different types of patterns than it saw before. So what's happening is it's adjusting as the markets are moving. So our strategy is always current, because the AI is adjusting it for the type of movements that it sees in the market. And that is the way that you're using AI. And that's a better explanation, hopefully, for people to understand how AI works. It has to gain knowledge itself from the time it's of inception. And like a child, when a baby's born, it still has all of those years of knowledge just pumped straight into it because it can go out onto the internet and find it. But for it to do something different and something better, time has to go by where it gains its own experience and then adjusts things suitably. I know that was a little bit of a long explanation, but I want people to understand, that a lot of people are using AI out there in the wrong way just to sell things, and it's not actually AI. And they're explaining how AI works, and it's not accurate.
Yeah, no, it makes a lot of sense. AI is purposely data-driven, and data is what makes it do its wonders.
Yes.
So since you use AI with your strategy, does that technically make it automated trading, or is it still manual to a certain
No,
extent?
it's actually, we like to do manual trading. I don't like to do automated trading. A number of years ago, as you probably know, you've been doing this for a little while with the podcast and listening to people, is that bots have come out. The word bot, yes, there's a bot. You put this bot onto your account and you're going to win a fortune. Well, the problem is most of those bots now have lost them all their money as well. So bots are only useful for a certain period of time. Why? Because they don't have that human element. They just keep doing. The bot is only doing what it is, what the software is designed to, what the logic does within the software. And you often see these bots where they're saying, okay, the market's going down a certain amount, it's bound to retrace, place a buy, and then another buy, and the market keeps going down and another buy, and then you've lost all your money. That's what happens with bots. If bots were any good, if automated trading was any good, don't you think the banks would get rid of all of their traders and save fortunes and just put bots onto a computer? No, they don't, because they need a human element, keeping an eye on things, that this bot, this software isn't going badly wrong. So we use it as an indication to us. It says, guys, there's a probable entry here. It satisfies the 68% requirement, and there's a buy. So our traders will then do a cursory glance at it and saying, well, actually, yes, look, it's come down to this level. Here's a support area. We've got liquidity at this point. Yeah, it's going to push it. So always my traders are putting the human element into it. So personally, I do not like fully automated trading. That is, I much prefer to have hands-on. Definitely, yes.
So I guess my next question is, do you think as AI evolves, automated trading can become a real thing?
Yes, I do. I really do think that in future, automated trading will become far better, because the data being taken by the AI systems will be relevant. They'll be latest information. At the moment, we don't have that situation. There's so much AI is only just starting to gather the information together. Because what AI will do with trading strategies, as I've said, it will adjust. When it starts to see things, hang on, this price movement, I haven't seen that for 5 weeks. And then it'll come up to us and say, hang on, something's changing here. We haven't seen it for 5 weeks, but we've seen this one coming on instead. So that is where you can then start trusting AI far more to become automated.
So you discussed using AI to help you enter trades. When it comes to your strategy and entering trades, what exactly do you look for to pull the trigger on the trade?
Within the industry, and particularly because the industry is dominated by retail traders, if you look at the number of traders, most traders are retail traders. There's only a smaller amount as a percentage, that are institutional traders. Yet the main money is made by and is traded by the institutions, the banks, etc., treasury departments, banks, and institutions, even hedge funds. They all provide liquidity into the market. But what needs to happen is those retail traders, what they're doing is they're the ones that are losing. They're almost the cannon fodder for the institutions, because the way that they're taught and the things that they use, the indicators that they use, means that the probability of them winning is very, very low, because of the reasons that I've told you now. So when we look at our strategies, I see some strategies which are peddled on the internet. I use the word peddled on the internet for somebody to make some money. And normally the people selling it, not the people who are buying it. And you see loads of indicators. There's colors all over the place. We just have a plain chart with maybe some moving averages, maybe a Fibonacci. It's very, very simple. But most of it is our support and resistance areas and order blocks. So we're looking for certain things to happen in a market coming into a certain area to be able to then go. So it's very simple. We have very simple strategies. And the simple strategies are the ones that work. People think they've got to have complex strategies. No. Very, very simple strategies.
No, it makes a lot of sense. Keeping it simple is always the best way to go, of course.
And that means that we don't have so many trades in a day, because we are looking for very, very high probability trading entries. And that is why we don't trade. We don't have many trades, and we have very simple strategies. They make the money.
And that also develops patience, for sure.
Of course it does, yes. That's correct.
So when you enter a trade, what is your process for after entering a trade? Do you kind of just set it, forget it?
Walk away.
You walk away?
I just walk away.
Really?
Yeah. Or I go and do, I go and do something else, look at another market. Yeah, I'm not interested. When I pull that trigger, it does what it's going to do. Once I'm committed to that trade, unless the trade needs to be managed. And what I mean by that is, say the trade goes a certain distance and our trading plan says that you've got to move the stop loss or do whatever, then I won't touch it because I don't care. Now that sounds really weird, but I don't care. Why don't I care? Because I know I'm going to have losses. I know I'm going to have winning trades. I know how many trades are going to lose in a row maximum. So why worry? And that is how my students don't have emotional roller coasters. Let it go. You've done your analysis. You know over the next 12 months you're going to make a great amount of money. So let it do what it's going to do, because it'll get there in the end.
So what's your strategy though for exiting trades? Do you usually wait for take profits to hit?
Normally, yes. The only time that I would say we would amend that is if there is news. If we see news coming out, we may make adjustments to the trade or even close it. There could be a very big announcement coming out, or Powell is speaking over in America. Then if we're in a nice profit, he can move the markets. But I don't just mean one way. They go every way. They're very, very volatile. You'll say something and the markets react one way. So why take that risk? Just close the trade. There's another one coming along.
And do you have a certain percentage where you take profits at? What's, I guess, like the risk to reward ratio?
It's risk to reward, yeah. We have a minimum of 1-to-1 risk reward, often 2-to-1.
And can you go in a little bit more of the details for people that don't know what that means?
Okay, let me explain a little bit more. If we are risking 1% of our account on a trade, then that is related. A lot of people don't realize that the risk that they're putting on a trade is totally dependent on one thing. Two things. One is the size of your account, and secondly, the size of the stop loss. A lot of people just say, well, I'll put 1% on each trade. No, some strategies actually will look at certain highs and lows of the market that have previously occurred. Yeah, the previous low, the previous high. So we will be adjusting our stop loss to whatever the rule of that strategy that we're running is. Now that could be the previous low. That means you have a certain stop loss. So it's not 20 pip stop loss on this strategy. You actually adjust the stop loss to the way the market's moving. So therefore, the stop loss then needs to calculate the amount of money that you put on. So if it hits that stop loss, it could be 30, 50 pips, 20 pips, 100 pips. Then you still only put the size of the lot size onto an account. So in other words, how much per pip you're going to risk based on the stop loss. And we give our students a very simple calculator that they actually put onto their trading software. And the software will look at what their account size is. You just put the risk, 1%, or 0.5% if somebody's trading 0.5% risk on this strategy. And they will put the stop loss and it'll automatically tell them how much to put on. So again, what we're doing is helping our students not to make mistakes. They will know exactly how much to put on, and they then know, well, I'm only risking 1% or 0.5% or whatever it may be. So we have little tools to help them, again, take that emotion. Oh my God, there's a trade. Stop loss this size. Oh God, I'm going to have to work out how much that is. No, just put the two figures into two boxes, press the button, it tells you how much to be able to put on. So what we're trying to do is take the emotions out of trading for students. There's always going to be emotions because we're human. But if we can do things in a certain way, as I've said to you, even with the way the analysis is done, and those students know what's going to happen, even with money management, we have a little calculator that they just stick it in, and then they know how much to put on there. Because in the heat of the moment, there's a trade, let's put it on. They can make mistakes. So we give them a certain method of placing a trade, what they need to do first, second, and third.
I really like how you try to remove emotions away because that's the most important part of trading. Now, let's just say you enter a trade. Is there ever a time in your strategy that you teach where you need to take exit out of the trade before it hits your stop loss?
Very rarely do we change the stop loss or get out of a trade before the stop loss. And that is, again, going to more of this robotic type of trading. If that's what our trading plan says, then don't mess with it. Because I've seen certain stop losses are put into certain places. For instance, the previous low, or the previous high. And you put them not at the previous high, but you put them a bit higher. Now, the markets love to go to certain positions that they've been to before. That is the whole theory of support and resistance. So you could say, oh my God, it's about to touch. The number of times we've said to students, leave it. And then just before it hits that stop loss, it's reversed and gone the other way and won. They would have had a winning trade. That's what the analysis showed you do. So don't mess with the analysis. Don't mess with the trading rules. So very rarely we will cut a trade. The other time that we may do, again, is news. There's a major news item coming out. We're already losing. Say there's a stop loss of 40 pips and we're already losing 30. Let's not risk it. Let's just cut it there because it's a big news. But only on very large news, because in certain circumstances, if the market spikes significantly, it can go through your stop loss and your trade doesn't close. It closes much lower. Now, brokers try to do things where they say, we will guarantee stop losses, but a lot don't. So, sometimes you can't help it. It's going to fly through and you can't close that trade quick enough. So we do things like that, but only on very major news items.
That makes a lot of sense. So since I'm assuming there's gonna be a lot of beginners watching, what is, for people maybe who never traded or still early on, what is the ideal account size, the amount of capital that someone should be trading with?
I would say £1,000.
£1,000.
Yeah. £1,000 is enough that when you put a trade on, say it's 1%, you're going to lose £10. It's not a great deal, but it is £10. And therefore, demo trading as an example, you don't go through the emotions that you do when you're trading your own money. So I would rather somebody put £1,000 in and then trade it very, very low lot size, 0.01 lots. 10 cents a pip. So therefore, when they're learning, they're going to make the most mistakes. The curve is the curve. You can't do anything about it when somebody starts something new. But trading with their own money gives them the reality of what trading is. So I would say £1,000, no more than that. Never risk any more than that whatsoever.
And you suggest people trading directly when they get into trading directly on a live account, not a demo, not maybe go through prop firms.
What we do with our students is, in the beginning, we tell them to trade demo. Because what I want to do is I want them to understand what they need to press, the figures they need to put in, and hit the button. In the beginning, they're going to make many, many errors. So let's make those many, many errors on a demo account. Once you've started to learn, this is what I've got to do, this is how the lot size calculator works, and they start to get a little bit more confident, that is when we move them over to a live account. So practice on a demo at the beginning. For somebody who knows nothing about it, they don't know what they're doing. They'll go to click buy and they'll click sell. They'll go to click sell and they'll click buy. They put the wrong size stop loss in, etc. So what I would suggest to them is use a demo for a small amount of time. When we do our courses, one of the first things we do is we teach them how to drive the MetaTrader or Leverage platform or whatever it may be. And we do that on a demo. Once they've learned that, then we say, right, now go live with a small amount of money.
Makes a lot of sense. And I guess one last final question I have for you, because a lot of people in our YouTube comments say this. I think a lot of people search for the internet. People are impatient. They want to become profitable overnight. And based on all the students that you've taught, what is a realistic timeline that it takes for someone to become profitable learning through you?
6 months.
6 months. What's current today? I saw online you said you taught about 150,000 students.
I think it's about 152 now coming out, 152,000. But that's since 2010. So it sounds a lot, but it is since 2010 because we're one of the longest running academies in UK and Europe.
Yeah, I know.
But that's quite a lot of people.
Yeah, no, it is. And so what's, I guess, success rate of those people hitting it within 6 months? Do you know those statistics?
No, I don't. I would say it's most probably around 60%. And if you wanted to take male, female into consideration, then females will comply to the rules and the requirements more than the men. So more females are more successful quicker than males, actually.
That makes a lot of sense. Paul.
Yeah, they say, I don't know anything about this, so they will stick to everything that they learn. Men will try and go off and sort of try little things themselves, but I find that the women are very disciplined.
And for people watching, I know your academy is called the UK Trading Academy. Do you necessarily have to live in the UK to be a part of it?
We have students in South America, America, North America, Asia, Europe, all over. Australia, yeah, New Zealand. So we have students all over. The way that we do it now, for those that don't know that much about UK Trading Academy, we are one of the only private educators in the world to be able to provide a professional MBA in financial trading, a master's degree level, fully accredited through a European highly recognized accreditation authority. Just because we're UK Trading Academy, anybody in the world can take that and to be able to go up to masters with us. So you can start at Forex Basics to get to learn a little bit about it, then go to our Pro Trader or our masters, and not only be able to become a professional trader making money from the markets, but also to be able to have that up on your wall, and your parents will be proud of you when they see the master's degree. But also it opens doors into banks, it opens doors into Forex brokers, because you have a master's in financial trading.
Yeah, you're definitely the first online academy that I've heard to do that. So that's really, really impressive.
You know what, Hunter? We were talking about the institutions and the retail traders, and I was saying, why aren't you following institutional traders? They're the ones that make the money. That is why we teach institutional trading. And I've got a great analogy for you. I saw a documentary where they took a load of aspiring car drivers and they took them around a racing track, and they took the time that they took to go around the racing track. And what they then did, which they didn't know, was they had Lewis Hamilton there. And they said to Lewis, just go around at 75% of the normal speed you would go around. And these guys were then timed, each one would follow him. Every single driver reduced the time that it took to go around the track just because they were following Lewis. Why? Because they were taking the same lines as he was. Because they were taking the same lines, the car wasn't tweaking so much. So therefore, they were going a bit faster as well. So not only did they take those lines, but they went faster. That just goes to show you, it's a great analogy where when you're following the right people, then you're automatically going to be able to increase your performance because you're following the right ones. So it's a heck of an analogy. And it was a great documentary. But they showed the psychology of driving, where those people would only go a certain speed around a corner because that's what they were comfortable with. But once they were starting to follow Lewis, they were taking the same lines as him, they felt far more confident to go quicker. And they took the same lines as well. It's the same with institutional trading.
And where can people find you? Where can people find your academy at?
Certainly if they go to uktradingacademy.com, you will see our website, and we explain everything to you there. It is a professional website. You won't see people dangling with huge chains and big fast cars and big houses. We explain exactly what we do and how we do it, because at the end of the day, people need to know what they're buying. And we also do webinars where people can come on and they can ask us questions. We even have a phone number. People can come up and say, look, I want to take the Masters. Tell me more about it. And we will have a chat with them. We'll have a Zoom with them and explain everything. So when you look at our market inside, you'll say, God, they don't market very well. Yeah, they don't go all over the place with, look how much money we've made today and look how much money we've made yesterday. That's not us. We want to give people good value for money and do what we say. And I'd rather do it in that way and have less customers, but those customers are satisfied, than going out with all the rubbish that you see everywhere else.
I like that a lot. Well, Paul, it's been a pleasure.
Yeah, great. Thank you so much. I hope
you got to catch
it's been useful.
Really
Yeah, catching a flight back to UK tomorrow.
Awesome.
Thank you so much. I've enjoyed being on here with you.
I have too.